Hello, everybody, and thank you for joining us this week for our weekly market update call for Monday, August the 17th, 2020. I'm Jay Gragnani, and here joining me this week is Ian Saunders, and hope everybody has had another nice summer week. We sit here now with just a couple weeks left in the traditional summer months, and some schools across the country are beginning to go back in person or virtually. And, the market over the course of the past week has continued to show some positive developments that we wanted to mention and talk through with you today in terms of just our kind of agenda items. Looking back, as we have been doing over the past few weeks, at some weekly performance information, discuss and talk about some of the continued improvements that we see across the U.S. equity and really global equity landscape, but specifically seeing domestic equities within Dolly move back up to number 2, and now coming close to moving back up to that number 1 position. We'll talk a little bit more about that in a minute. Trends on the S&P 500, not only the index, but the individual stocks continue to show improvement across the board, as well as some notable developments underneath the hood, if you will, of the asset class group scores page. But with that said, if we just kind of take a step back for a second, it was another positive week for the S&P 500. With the S&P 500 up just over 60 basis points. The S&P equal weighted index actually, doing better than the S&P over the course of the past week. There hasn't been too many times that we have talked about the S&P equal weighting doing better, but the past couple of weeks we have seen some positive developments out of some of those smaller and mid-cap names, and then we've seen some strength out of some other areas that have not really been the leadership trends this year. You're looking at financials over the course of the past week doing better than the S&P as well, and small caps over the past month have really come along. The IWM up about 6.8% over the past 30 days, still down about 5% on the year. But in terms of broadening out in the participation across the market, that's been a trend that has been important and interesting to watch. From a sector perspective, technology continues to carry the baton in terms of leadership trends across the sector perspective. Right now, with technology up still over 24% on the year. And so with that said, there hasn't been a whole lot in terms of leadership changes across the sector spectrum that we've seen. We continue to see strength across, the growth and technology sector, communication services, all areas of the market that continue to do well. But, as we mentioned, and we'll drill into this a little bit more, is the participation is broadening out. And over the course of the past month, in many ways, there hasn't been a disadvantage to owning some of the relative weaker areas of the market. The growth area continues to perform well, but some of the other areas have begun to participate. And what that's done, if you look at a chart of the S&P 500, specifically the 20-point chart of the S&P 500, all of these positive things have culminated now into this test of previous highs for the S&P. This is the 20-point chart. So looking at the 20-point chart, that 3380 area is where that chart got up to here recently, as well as back in February, with the ultimate high being 3393. So the market continues to flirt with those levels, and we'll continue to see how this week plays out to see if the S&P is able to notch a new high. But with that said, in terms of support, so the market has certainly run. It's not what we would consider to be extremely overbought by any stretch of the imagination, but it certainly is in the overbought, oversold world. On the overbought side of the ledger there. So in the event that we do see a market pullback in the S&P 500, first real area of support on the chart is in the 3200, 3220 area. And then after that, right around the 3120 to 3140. So, we'll continue to watch and monitor the S&P if it's able to get up and test, certainly getting close to testing those highs and getting close, not quite getting there, but certainly getting close in those tests. So With that said, as we're looking through a number of individual stocks and talking about just the improvement, Ian, we've seen quite a bit of improvement in the trending picture for stocks within not only the S&P 500 but within the broader equity market as well.
Absolutely there, Jay. And when looking at this chart here, the 20-point chart of the S&P 500, we can see that this chart in and of itself did move back to an overall positive trend and back in April of this year, and has continued to climb higher since. And then the further improvement that we've seen over the past couple weeks here has led to some indicator reversals that we see for some of the names within the S&P 500. Taking a look at the percent positive trend chart for the S&P 500 here, which measures the percentage of stocks in the S&P 500 that are trading above their respective bullish support lines, or what we would call an overall positive trend. We saw this indicator climb as high as 82% in June of this year, before reversing back down into a column of O's, down to a 70% threshold. And then with movement over the past couple of weeks, we actually saw right towards the beginning of last week, this indicator reversed back up into a column of X's at 78%, where it sits here today. And what this is telling us is that as we see the major domestic equity index, the major benchmark there, the S&P 500, continuing to climb back towards all-time highs, we're seeing more names participate in that upwards movement. This percent positive trend chart is viewed as one of the participation indicators that we have, and is going to be looking at participation on a slightly more long-term basis than maybe the more frequently mentioned chart, the bullish percent for the S&P BP SPX, looking at the percentage of buy signals. We saw that chart move higher as well, but then seeing further follow through across the more longer term focus indicators that we have here, such as the PT SPX percent positive trend for the S&P 500, is certainly a good indication for the broader state of the large cap domestic equity space. And as you said there, Jay, we've seen that reflected across some of the other areas within the market as well. The PT NYSE percent positive trend for the New York Stock Exchange, which instead of just measuring the number of stocks in the 500 large cap names we see in the S&P 500, the PT NYSE is looking at, okay, what percentage of names out of the broader New York Stock Exchange, roughly 2,000 names, what percentage of names in that particular basket are trading in an overall positive trend above their bullish support lines? We saw that reverse back up into a column of X's as well. It crept down right towards that 50% level and then reversed back up into a column of X's there last week as well. So it's definitely a good sign to see the further follow through on the case of these longer term focus indicators reversing back up while remaining above 50%. We're looking at this chart, we can see historically that we use that 50% level as really kind of the line of demarcation for the positive trend charts. Ideally, you'd like to have more than half the names in the basket that you're looking at be trading in an overall positive trend in order to present a positive outlook for the future state of those names that you're examining. And so here we can see that reversals back up above 50% have tended to come at opportune market environments here. And in order to dig a little deeper into some of that movement, we took a look at some forward performance for the S&P 500 following reversals in the PT SPX indicator that we have here on the NASDAQ Dorsey Wright platform. And in looking at these reversals, we can see that the average forward return coming off of any reversal, looking at the yellow line there up top, is generally positive on a 1 week, 2 week, 1 month, and 6 month basis. So following any reversal there for the index, just as a kind of a benchmark for these, in taking stock of these reversals, we do see generally positive returns. But when you look down at that first green line, we can see the reversals up while the indicator is still above 50%, has been a further positive sign for the broader domestic equity market, at least in the case of the S&P 500. We can see positive returns across the board for when we see a reversal back up into a column of X's while the indicator is above 50%, like we had last week. And we see more outperformance looking at that 2 week, 1 month, and 6 month forward return aspect. Over 1% positive returns for each of those, and then broadening out to that 6 month, over a 3% positive return on average when this indicator reverses back up into a column of X's while already being above 50%. In looking at it from a batting average perspective, in looking at the number of times it's reversed back up above 50%, we can see that the indicator has done that 20 times during the course of our test here, which went back to the early 2000s time period there. There were 20 times where the indicator reversed back up into X's while above 50%. And we see, and looking at it from, again, that forward return standpoint, what percentage of how many times was the 1 week, 2 week, and 1 month, and 6 month time periods positive after that? We see that continue to increase as you move out largely there. Looking especially at that 2 week number, about 80% positive returns at 16 out of those 20 times that we see that indicator show positive returns after it reverses back up into complexes for the broader S&P 500. So definitely a good sign to see the further follow through on the case of some of these longer term indicators, such as this PT SPX chart that we see here. PT NYSE, as I mentioned, also is reversed back up into a column of X's there. And we see this reflected across the board on some of the other more focused positive trend indicators, looking at the positive trend for small caps, PT SML, the positive trend for mid caps as well, PT MID. All of those indicators showing in a column of X's, showing that further longer term picture of at least positive signs that we're looking out towards as we wrap up head towards the end of the summer months here, as you mentioned there, Jay. And we've seen this reflected as well in some of the other more relative strength focused indicators that we have on the platform as well. Specifically, they're looking at the Dolly tool, Jay.
Yeah, and we talked last week about Dolly moving up to number 2 and continuing to narrow the gap, if you will, between that number 1 spot, and that continued throughout last week as fixed income and domestic equities is just separated now by 7 signals. And the market, if it continues the trend, certainly wouldn't be surprised to see that happen, potentially soon, but certainly something we'll take a look at. And you'll recall it was mid-March when U.S. equities ultimately fell out of number 1. March 12th, U.S. equities moved from number 1 down to number 3, with fixed income and cash moving up to those top 2 spots, and really just now seeing domestic equities over the course of earlier this month move back up into that number 2 spot, with fixed income still holding there at number 1. And there's been a lot of strength within fixed income markets as well here over the course of the past really couple months, especially in some areas that tend to be more equity linked areas, so things like convertibles and preferreds and high yields have actually done well, and in some cases provided some equity-like returns within the fixed income markets. Nonetheless, fixed income and equities in general have both participated over the course of really the past year, some to a broader degree. But nonetheless, that's a development that we'll continue to monitor very closely. I know it's one that many of you watch very, very closely. And for those of you who are utilizing Dolly-based strategies, what we've seen here over the course of the beginning of August at least is a beginning of an increase back into the equity exposure. If we see U.S. equities move up to number 1, that will likely be another catalyst to increase some equity exposure. But certainly something to watch. Also, for those of you who have access to the research platform, you can set alerts on Dolly, and the system will notify you when something across the asset classes change. So if U.S. were to move up to number 1, that wouldn't be an example of an event that would trigger an alert, but also if things are changing within the asset classes. So if the sector rankings are changing, or if there's any sectors moving up or down, then you can also be notified of that. But another within the broader Dolly page, another indicator that we look at is something that we call the cash percentile rank. And this is available on Dolly. If you go to details, it doesn't have all of the history on it, but you can see a number. And that number, and then you'll see a colored light next to it. It's either going to be red, green, or yellow. And that color is directly correlated to the cash percentile ranking. A low number means cash is ranking low, so 0 would basically mean it's at the very bottom of a relative strength matrix. Versus, if it gets a high number, would be positive for money market, but negative for that asset class. And so right now, when we look at the domestic equity percentile rank, and so again, these percentile ranks are per asset class, and so basically, if you think about a big relative strength matrix and of a bunch of U.S. equity representatives in there, and then we throw money market into the mix. So it's just pinpointing U.S. equities, and it's looking to see where cash ranks within this big relative strength matrix of U.S. equities, U.S. equity things. If we look at that today, if you're on the details page of Dolly and you look at that today, that number for domestic equity is 10.91. Let's call it 11% for round number's sake. Basically, what that means is that cash is beating just 11% of the U.S. equity representatives. So saying another way, 89% of U.S. equity representatives rank above money market at this time. And that light is green. So anytime that number is 33% or lower, that light is green. That's going to signify a generally healthy environment for the various equity options that are out there. A light of yellow means that cash is somewhere between 33 and 66. So it's kind of in the middle third of that matrix. It means a bit more caution, be more diligent about what areas of the equity market that we're going to, because the chances of throwing a dart and finding something that's working just simply isn't as great when you get up above that 30% level versus, say, a time period like now where you're at 89% of things are above money market. And then lastly, if that light were to turn red, that would suggest that number is up 66% or higher. And those market environments don't happen a whole lot. I mean, you can see on this chart here on the left-hand side is the entire history back to 99. And that gray line on the chart signifies that 66% level. So it doesn't happen a whole lot. You saw it get up there in the 2000 to 2002 time period. You saw it get up there again in the 08-09 time period. Then you saw it get up there again here recently through this market environment. And if you kind of zoom in here recently, you've seen that go from a reading that got in the upper 90s. So money market at one point in time was up in the upper 90s and has now fallen all the way back down into basically the bottom 10%. So, again, another indicator, another bit of perspective that can be had. More often than not, this indicator spends its time, or at least over the past 20 years, more often than not spends its time somewhere below that 30% level. But, when it gets elevated, those are certainly times that we want to pay attention and be aware of what's going on within the equity market, whether it's through individual stock selection or just being a little bit more diligent about the allocations towards equities that we're going. So, that's a bit more perspective, something that you can look at within Dolly. If we shift gears a little bit and look at, outside of just domestic equities, the macro view asset class group score page is something that we've tried to highlight through these calls every week, and haven't seen a ton of changes in there, but some very interesting developments.
Absolutely there, Jay. And an indicator, like you mentioned there, looking at the cash percentile rank, right? Looking at, okay, how strong is cash relative to our domestic equity universe? We have a similar indicator on this page that we focused on over the past couple of weeks. It's called the money market percent rank, which you can see here in the upper left-hand corner. It's also going to be found in the upper left-hand corner of that asset class group scores page for those of you that are following along on the research platform. The money market percent rank, you can see there with the current reading of 6.34% through trading on Friday. You can think about it in a similar fashion to that cash percentile rank, basically saying, okay, out of our investable universe, what percentage of names is cash beating? Except in the case of this indicator, instead of just looking at domestic equities, we're looking at the broader, all 135 plus groups that we have on the asset class group scores page, which is meant to represent just that, your full investable universe, looking at everything from individual domestic equity representatives, sectors, stock and style classifications, the different fixed income breakdowns or different areas within commodities. So a variety of different areas that we're looking at here on this page. And we see that the cash reading, that money market percentile rank, what percentage of those 135 plus names of cash beating has continued to fall as the broader global equity space has continued to rally. Moving down to the 6.34%, crossing down beneath that 10% threshold is a good line of demarcation to take note of in terms of looking at prior market environments that we've seen sustained growth for domestic equities have typically come with times when we see the money market percent rank down beneath that 10% threshold. And we see that this fell down beneath that 10% mark for the first time really since the end of February of this year. So continuing to see that particular indicator, that money market percent rank, or as we often call it, the MMPR for short, continuing to drop is definitely a positive sign for the broader global risk-on asset space. And then the other indicator you can see directly beneath it, that U.S. equity core percent rank that we see at 93.66%. It measures the S&P 500 index funds as our core market representative, our core domestic equity market representative, to see, okay, what percentage of names is a core domestic equity market beating? And we've seen this indicator continue to move higher as well, largely simultaneously with that money market percent rank continuing to drop. So the U.S. equity core rank moving back up above 90% to almost to 94% that we see there. It really speaks to the broader strength that we see for that large cap focused space. Large cap domestic equities have really been the bellwether area to lead most of the global equity markets higher through this recent rally. And we've seen that shown through the sustained higher percentile rank from that core PR, as we call it, that U.S. equity core percent rank. But when looking at the broader asset class group scores page, we can see a variety of names are scoring in high territory that have continued to dampen that MMPR, seeing further participation from many areas outside of equities, has continued to push that MMPR, that money market percent rank, lower. And in looking at it from a historical perspective, we can see that this reading climbed above 50%, which is really kind of that first major line of demarcation that we tend to track. Some of the cash triggers that we have for some strategies on the Dorsey Wright Research platform use that 50% level as a potential trigger to cash. We did see it move above that 50% level. It did not stay above that level long enough for those strategies that do follow that MMPR indicator to move to cash. But we did see it move above that 50% level. And you can see that in looking back throughout history, it's something that doesn't happen all that often. So seeing it continue to fall back down beneath 25%, and then ultimately with movement over the past week down back beneath that 10% level is certainly a positive sign as we look to wrap up the summer months here and head towards the close of the year. When looking at the asset class group scores page, again, it's looking at 135 different groups that are all going to be sorted there initially by their average score of the funds included within each group. So for all ETFs and mutual funds in the platform, have a fund score that goes from 0 to 6, 0 being the worst, 6 being the best. We take each fund, classify them into one of those 135 different groups, and then rank those groups by the average scores of the constituents within each classification. Another way that we can view more recent movement on the group scores page is to sort the page by score direction. So what we're looking at here is taking the top end, so all 135 groups, and then resorting the page. Instead of being sorted by the average score column, which you can see there in the middle of this table, we're sorting it by score direction. So how has the score moved, either from a high or a low, over the past 6 months? So it's not necessarily saying, okay, 6 months ago the score was X amount lower based upon that direction. It's looking at a movement from a peak or a trough over the past 6 months. And we've seen a lot of groups on the group out of those 135, a lot of those groups showing positive score directions, almost all those groups showing some positive movement as the broader domestic equity, global equity, and even the fixed income space has continued to show strength from a score standpoint. A lot of areas showing very positive score direction. But over the past week, we saw some areas, maybe more surprising areas we haven't seen as much sustained growth through this recent market rally, have continued to push higher and shown very, very positive score directions, with U.S. microcap now showing it being the most improved group on that asset class group scores page based on score direction. We also have some other more small cap focused areas. You can see small cap growth, small cap blend on there as well, with score directions above 2.0, and some other sectors that have been maybe out of favor from a relative strength perspective, showing some more recent improvement, looking at basic materials up there with a score direction of 2.77. And interestingly enough, we see this isn't just contained there to the domestic equity side of things. A lot of international areas are showing significant strength as well. With Russia and India, the major improvers there from a directional standpoint, the broader emerging market space in and of itself, a major improver as well. This really speaks to the breadth that we're seeing at the top of this group scores page, with 103 groups currently possessing an average group score above 3.0, and then 45 of those are possessing an average score above 4.0 that we call blue sky territory. As you see here, those groups with an average score above 4.0 are going to be highlighted in blue on this page. Those above 3 will be highlighted there in green. So really showing some sustained improvement from some areas that have not seen as much improvement as others over the past couple of weeks here. And in looking at how this relates to the different percentile readings that we have, looking at the money market percent rank and that U.S. equity core percent rank, the continued improvement from a lot of these broader areas has continued to push that money market score down, and we would look for that to continue as if these areas do continue to improve. Either from a score directional standpoint in the weeks to come. But one thing to keep in mind is that we do see that in looking at that U.S. equity core percent rank, so the strength of the core domestic equity market as measured by the S&P 500 index funds group, as we mentioned earlier, moved above that, above the 90% threshold and in the top 10% of groups on the page. And looking historically, at least in recent history, that is not all that new. We've seen for the past few years, prior to the market turbulence that we saw there in February, the U.S. equity core has maintained a high percentile rank above 90% for a good chunk of that time frame. But as we see these other areas continue to improve from a directional standpoint, it wouldn't don't want to be afraid if that percentile rank does decline a little bit as we see some of these other areas, your small caps, and some other sectors continue to rally. If that score did back off, as long as it remains in that higher field position relative to the rest of your global investable universe, still something to keep an eye on there, and really keeping an eye on what areas are beating the core, what areas are beating money market, rather than focusing specifically on the movement from that U.S. equity core percentile rank in and of itself. So if it continues to remain in high field position, as some other more focused groups might move above it from a score directional standpoint, just something to keep note of and something to keep an eye on for those areas that you might be looking at to improve on performance or returns there outside of the broader domestic equity indexes in and of themselves.
That's great, a great view there, Ian, and perspective in terms of, what's really been going on underneath the surface. And you look at those things like micro caps and, Russia and India and some small, it certainly wouldn't on the surface see those types of things. So I think this, when you look at asset class group score page, you have the ability to change the views and sort by any different columns. And so certainly a lot going on underneath the surface of the market as we continue to head through the summer months with just a couple weeks left. So with that said, for those of you obviously who have access to our research platform, all of this information is something that you can access. We try and also provide daily commentary in terms of what's going on, if anything's changing with any of the indicators, not just things that we talked about today, but also provide individual stock and ETF ideas out there in the market. If you don't have access and you're interested in obtaining a login, you can sign up for a free 30-day trial, and we can set up some time to go a customized demo walkthrough of the website. As always, if you have any questions, comments, concerns, you can reach out to us directly. Our phone number right there, email address right there at the bottom of the screen. So we, as always, appreciate you taking time out of your day to join us for these weekly market commentary update calls that we've been doing this year. So if there's anything we can do to help you and your business, please don't hesitate to reach out to us. Otherwise, thank you again for joining, and look forward to talking to you next week.